Let's get you some more market perspective on that note. Rahul Chadha, head of Asia Pacific Investment Division and Mirae Asset Global Investment joins in from Hong Kong. Rahul, hi, morning. Over the past couple of months, some institutional investors have been speaking about big concerns for India, policy inaction, deficit monsoons. Are these factors a worry for you as an investor?
These concerns have clearly weighed on the mind of investors. But what people are also looking at is that the big bull market which we saw in commodities over the last decade may be coming over, and India stands as a natural beneficiary of that. If we see elsewhere growth is slowing down, and India, because of its demographics, offers a good opportunity over the next 3 to 5 years. Clearly, post the rally which we've seen in markets over the last 2 months, further upward movement would be contingent on policy reforms from the government and easing of inflation.
Rahul, how do you see flows into Indian equities shaping up given the kind of dismal domestic backdrop we are in?
We've seen very strong flows for India in the current year, I mean, nearly to the extent of about $10 billion. We continue to expect flows coming in, though over a medium terms, because valuations are not that attractive anymore. So large caps seem fairly valued. So flows may ease a bit, but if government delivers on the commitment to do the much needed reforms to attract further investments, FDI, kickstart local investment climate, I think flows would be supportive.
Rahul, do you think the widening current account deficit may impact RBI's monetary policy focus from inflation management to managing external risks?
Clearly, widening current account deficit is one of the key reasons why RBI has not eased in recent times. They are fairly contingent of the fact that we need to slow down the Indian economy to a more moderate level of 5 to 6% growth so that the reserve drawdown is minimal. Post a near 20% currency depreciation, what we've also seen is trade account has stabilized for the month of June. So this widening current account deficit, along with high inflation, is the key reason why the central bank is on hold.
Rahul, you've been bullish on banks and you like banks like ICICI Bank, Bank of Baroda. But are you not worried about what's happening to the banking sector? NPAs are going up, margins are coming down.
We've been positive on the private sector banks, which have shown relatively much better ability to tackle with the NPAs. The gross NPA accretion is fairly minimal for these banks. We underweight on the public sector banks, which have borne the brunt of this NPAs. Notwithstanding that, if the slowdown in the economy continues, some of these private sector banks may also be impacted. But we still continue to like certain mortgage finances where loan-to-value ratios are fairly reasonable and which may get impacted the last in terms of a slowdown.
So how concerned are you about poor order inflows, high competition playing out on the cap goods sector, and would you be underweight then?
We remain underweight that sector because in light of inadequate order flows, high competition, margins remain under pressure, order book to bull current sales ratios are falling for these companies. So we remain fairly selective and underweight the sector.
What's your stance on the telecom sector, given the kind of regulatory rut that sector is stuck in?
In light of the current uncertain regulatory backdrop and the poor performance in the last quarterly results, sectors become attractive. So I think over the next 6 months, once the auctions are there for the 2G spectrum, we should see bottoming of the sector. And then over the medium term, it may offer an attractive opportunity.
So Rahul, do defensive sectors appeal to you in India, given the strong bout of volatility in the market?
The defensive sectors like FMCG and pharma have done well, so clearly look kind of a fairly valued over 6-9 months perspective. But if one has a medium-term 2 to 3 year perspective, I think these sectors still offer reasonable growth, which is much higher than what one sees elsewhere in the region, and we continue to stay invested in these sectors.
So what do you think would be the next trigger? Policy action, global factors? What to your mind will really dictate Indian markets for next 3 to 6 months?
I think it's going to be a combination of both. Policy action kind of drives the local market up, but near-term valuations may kind of cap an upside. Outside that, global factors are also important because post the ECB statement that they'll do whatever to protect euro. The tail risk is off, but should people get concerned again about any kind of a risk on euro, we may see all markets capitulating.
So is there any more steam, Rahul, left in IT and auto stocks in the light of the high interest rate scenario as well as the weak currency?
Some of the IT names have held on well despite the uncertainty for the sector, because these companies have given healthy performance, about 10 to 15% sales momentum, sales growth. Essentially, we believe that sector offers potential over medium term, but near term, again, valuations look fairly okay for this, and near term upside may not be there much for the sector.
Also, finally, within the IT space, what are you bullish on?
Over a medium term, which I would say is over next kind of a 15 to 24 months, we still like the private sector banks, pharmaceutical, some of the IT names, and again, consumer sector in India.
Rahul, good to have you on the show as always. Thanks for taking time out.